Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by stress testing company balance sheets until they crack or prove their strength. Today, Guardant Health is going under the microscope. Now here's the puzzle, right? How can a company be putting up these absolutely explosive, almost 40% revenue growth numbers, and at the same time be operating with $1 billion expense run rate, just burning through piles of cash? That's the real conflict here, and that's what we're here to figure out. We're going to find out if this company is truly building a fortress of medical innovation that's meant to last, or if it's just a really, really expensive and hollow facade. We're here to find the real structural integrity.
Yeah, exactly. I mean, this is the classic growth at all cost story we've seen 1,000 times. And as an investor, you have to know if this particular story has a happy ending or not. You see the headlines, right? Revolutionary cancer screening tech, incredible top-line numbers, but that doesn't tell you a thing about the foundation. So is this a skyscraper in the making? A company that's going to own its market for the next 20 years? Or is it just a beautiful glass house built on a mountain of debt and shareholder dilution, just waiting to shatter the moment the market turns or the easy money dries up? The stakes here are just incredibly high. And today, we're going to find out if this is a true ground floor opportunity or if it's a trapdoor waiting to spring.
All right, let's get into the guts of this thing. Here is our blueprint for today's stress test. First up, we're going to examine the growth engine they've been forging. We're talking the steel frame of the bull case. Then, we're putting that billion-dollar burn under a huge magnifying glass to really understand the true cost of all this construction. After that, we'll see if the foundation they claim they're reinforcing is actually solid or if it's just sand. Then, we're going to dedicate a whole segment to what we're calling the shield gamble, and trust me, you're going to want to pay attention because this is the big one. Then we'll scrutinize their 2026 blueprint, which is basically their promise to the market. And finally, of course, we deliver the iron verdict. Let's get to work.
Okay, let's kick things off with the bull case, because honestly, you can't argue with these top-line numbers. This isn't some pie-in-the-sky pre-revenue story stock. No, this is a company that is executing with what I can only call brutal efficiency. When you're looking for real structural strength in a business, you have to start with revenue, and Guardant's numbers, they are powerful. They are forging a serious growth engine that seems to be firing on every single cylinder, and you just can't deny the momentum. So let's look at the headline number that has Wall Street so unbelievably excited.
Look at this. This one slide. It represents pure, unadulterated velocity. A 39% year-over-year jump in the fourth quarter, hitting $281.3 million. Come on, that's not just growth, that is serious acceleration. In this kind of market, trying to find a company that can expand its sales by nearly 40% in a single year, especially at this scale, is exceptionally rare. This right here is the gleaming exterior of the fortress. It's that powerful first impression that just pulls investors in, it smashes analyst estimates, and it makes the company look absolutely impenetrable from the outside. It tells you one thing very clearly. Demand for their products isn't just strong, it's getting stronger. It's intensifying.
And to be fair to the bull case, this isn't just a one-trick pony. The strength here is broad. When you actually break down the full-year revenue, and we're talking nearly $1 billion here, at $982 million, you see a structure that's supported by multiple heavy-duty pillars. The core oncology business, which is their bread and butter, it grew a very, very respectable 26% to over $683 million. Then you've got the biopharma and data segment, a really key part of their long-term competitive moat. That's up a solid 18%. And then you have this new pillar, screening, which basically came out of nowhere to bring in almost $80 million. So it's not all one thing. That's the crucial point. This is diversified strength. It's not one hot product that's dragging the entire company forward. No, each one of these divisions is pulling its own weight, and that suggests a really robust and resilient business model. They're building a foundation that can withstand a shock to any single part of the operation. Now that is what a durable structure is supposed to look like.
And hey, you don't have to take our word for it. The co-CEO, Helmy Eltoukhy, he called it an outstanding end to a great year. He credits it to, and I'm quoting here, breakthrough innovation and best-in-class execution. Now, okay, normally that might sound like just a bunch of corporate jargon, but let's be real, when you're posting nearly $1 billion in revenue with 33% annual growth, you've kind of earned the right to say your execution is top tier. The narrative from the C-suite, it perfectly matches the numbers, and it paints this picture of a company at the absolute top of its game, building something truly massive. But every single major construction project has a cost, and the costs here, well, they are staggering.
Exactly. And this is where the whole picture gets a lot darker. For every dollar of that gleaming revenue that shines on the outside, there's actually more than $1 of cost being poured into the foundation, and frankly, it looks like it's leaking everywhere. The bull case is incredibly compelling if you only look at the top line, but it completely ignores the enormous, and I mean unsustainable cost of this entire project. So let's talk about the billion-dollar burn, because this is where that beautiful facade starts to show some very, very serious cracks.
So here it is. This is the number that should give every single bull a serious moment of pause. A net loss of over $416 million for the full year. Just let that sink in for a second. After bringing in almost $1 billion in sales, they still ended up nearly $500 million in the red. This is not some small rounding error on the path to profitability. No, this is a massive structural deficit. This is the first major crack in the armor. It screams that the cost of their growth is just astronomically high, and it forces us to ask a really uncomfortable question. Is this business model even viable in the long run?
And this just brilliantly illustrates the core problem. The math is really simple, and it is absolutely brutal. On one side, you've got revenue of $982 million. Very impressive, we get it. But look at the other side of the ledger. Operating expenses of $1.07 billion. $1 billion. They are spending more money just running the business day-to-day than they are making from selling their incredible life-saving products. So I have to ask the question, is a building truly strong if the cost to just maintain it is more than all the income it generates? You can't outgrow a spending problem forever. At some point, this equation has to flip, or the entire structure becomes fundamentally unstable.
Okay, that's a fair point, but you're giving me a static, snapshot analysis. It's like looking at a construction site that's covered in scaffolding, with cranes and raw materials lying everywhere, and calling the whole project a failure before the building is even close to being finished. What the skeptics are missing is the crucial work that's being done quarter by quarter to reinforce this company's financial foundation. They have a clear blueprint to get to profitability, and the evidence shows they are actually executing on it. Let's look at the underlying improvements that show the trajectory is actually positive, not negative.
Now, pay very close attention to this slide, because this is important. Non-GAAP gross margin improved from 62% to 66% in just 1 year. Okay, so why does this matter? Well, it matters because it proves they are becoming more efficient. It means that for every single test they sell, they are squeezing more and more profit out of every single dollar of revenue. See, this isn't just about growing sales, it's about growing sales profitably. This improvement shows that as they scale up, their costs are not scaling at the same painful rate. That's what we call operating leverage, and it's the absolute first and most important step on the path to company-wide profitability. It is hard proof that the core business is getting financially stronger, not weaker.
And here's even more hard evidence. Let's talk about cash, because that's the actual lifeblood of any company. In 2024, they burned through $275 million in free cash flow, a tough number. But in 2025, that number dropped to $233 million. They improved their cash burn by $42 million, even while they were investing heavily in launching and scaling up the new Shield test. This is not a company that's spiraling out of control. This is a company demonstrating real financial discipline. They are actively managing their expenses and successfully slowing the rate at which they consume cash. This is tangible, measurable progress towards becoming financially self-sufficient. They're patching the holes in the boat while still sailing full speed ahead.
Sure, a plan is one thing, but execution is another. It's really easy to draw a nice-looking timeline on a slide, but are they actually hitting these targets? I mean, it looks like a long way to the end of 2027. They are. Look, this isn't just some roadmap for the distant future. They're already arriving at key destinations, and in some cases, ahead of schedule. Take a look. In the fourth quarter of 2025, that's last quarter, their core business, so everything except for the new Shield test, was already free cash flow positive. That is a massive milestone. For the full year of 2026, they expect that entire core business to be cash flow positive. This proves that the company-wide cash burn we're seeing is almost entirely due to a deliberate strategic investment in Shield. So they are targeting company-wide break-even by the end of 2027. This isn't some desperate hope, it's a multi-year strategy where a profitable core business is funding the next giant wave of growth. The foundation is setting, right on schedule.
Okay, and that brings us to the biggest variable in this entire equation, the Shield screening test. This is the wild card, the whole shebang. This is either the company's next skyscraper, the one product that's going to catapult them into a whole new stratosphere of healthcare, or it's a giant money pit that will drain all the resources from their profitable core business and put the entire company at risk. This is the ultimate gamble. Gamble is a strong word. I'd call it a calculated, very high-stakes investment in a market that could be worth tens of billions of dollars.
But you're right about one thing. The success or the failure of Shield will absolutely define this company's future for the next decade. So let's break down both sides of this Shield equation.
All right, let's start with the reality of today, not the promise of tomorrow. Right now, on the income statement, Shield is basically a rounding error. It accounted for just over 8% of the company's total revenue in 2025. The other 92% came from the established, more mature oncology and biopharma businesses. So when we see that $233 million cash burn for the year, we know that a huge chunk of that is being spent to prop up a division that is barely contributing to the top line. From a purely financial perspective, right here, right now, Shield is a drag on the profitable core. It's a very, very expensive experiment.
An experiment? You're looking at revenue, but you should be looking at adoption. The ramp here is just staggering. In the last quarter of 2024, they performed 6,400 Shield tests, okay? A year later, Q4 2025, they did 38,000. That is an almost 500% increase. But the key, the real story, is the guidance for 2026. They're projecting between 210,000 and 225,000 tests. Do you see? This is not linear growth. This is exponential, classic S-curve technology adoption playing out in real time. Yes, it's a small part of revenue today, but this explosive growth in demand is exactly why they are investing so heavily. This isn't a drag. This is the company's future skyscraper being built right before our eyes. The market is screaming for this product.
Okay, so that brings us to the future. Let's put the company's official 2026 blueprint under the microscope. This is management putting their credibility right on the line, telling the market exactly what they expect to deliver. This isn't our speculation. This is their guidance. It's their promise to shareholders. We need to scrutinize every single one of these numbers to see if the fortress they claim to be building actually holds up to a real inspection.
Let's break this down. They're guiding for total revenue of $1.25 to $1.28 billion. That is another year of ferocious 27 to 30% growth. Now look at the screening revenue line. They expect it to more than double, to between 162 and 174 million. That is massive acceleration. And critically, look at the free cash flow burn. They expect to reduce it again down to the $185 to $195 million range. That's another 19% improvement year over year. This is a picture of controlled, disciplined hypergrowth. Controlled? I'm looking at non-GAAP operating expenses, which are still clocking in at over $1 billion, 1.03 to 1.05 billion to be exact. So even when their revenue finally clears that billion-dollar mark, their expenses will still keep pace. They are explicitly guiding for another year where spending outstrips revenue. The growth is impressive, I will grant you that, but they are still building on an unprofitable foundation and promising to keep spending aggressively to do it. The improvement in cash burn is positive, sure, but the absolute dollar amount they're incinerating is still massive.
So that brings us to the final assessment. We've examined the steel frame of the revenue growth, and we've inspected the very real cracks in the foundation from that cash burn. We've seen their plan to reinforce it, and we've analyzed the high-stakes bet on Shield. Now it's time to put it all together and deliver the iron verdict. Is Guardant Health a rare opportunity for investors to get in on the ground floor of a future medical titan, or is it a cleverly disguised trap?
So the bull case is clear and is powerful. You have ferocious 30+% revenue growth at scale. You have improving gross margins that prove the underlying business is getting more and more efficient. There is a clear, disciplined, and so far successful path to break even. And you have that explosive exponential adoption ramp in a massive new market with the Shield test. This is the blueprint for a market-dominating fortress. But the bear case is just as compelling and, frankly, much more sobering. You have a massive cash burn that's fueled by over $1 billion in annual operating expenses. Full profitability by their own timeline is still years away. We're talking the end of 2027. The entire strategy is heavily, almost completely dependent on that one Shield bet paying off. And the high cost of this growth strategy could threaten the company's stability if there are any unexpected bumps in the road, like a recession or a competitor that moves faster than they expected. It looks very much like a costly, fragile facade.
Ultimately, it all comes down to this. Guardant Health is not a finished product. It's an active, high-risk, high-reward construction site. The bulls, they see a future skyscraper, a dominant force in oncology diagnostics, and they believe the current costs are simply a necessary investment to build that future. The bears, well, they see a project that is wildly over budget, behind schedule on profitability, and dangerously leveraged on one big unproven bet. The numbers, as we've shown you today, can support both arguments. The question for every single investor, after looking at all the evidence, is a simple one. Do you believe in the blueprint? That's all for this edition of Iron Financial. Stay sharp and keep forging that portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.